Welcome, everyone. It's Alex King here. I'm the CEO at Cestrian Capital Research. For you today, we have a special guest, Jay Abane. Jay runs the Jay's Option Service that we're delighted to host on our platform. Jay is a data scientist and a professor by background and applies all of that mathematical training into his options analysis. And the work he does is conducted, informed by how a market maker views options rather than the traditional shoot for the moon and sometimes end up at the gates of hell buying and selling options strategy. Jay's going to come talk to us today about Q1 options expiry. So we have Q1 options expiry tomorrow, Friday. We also have FOMC next week on the 19th and the 20th. And taken together, these events can generate quite some volatility in markets. And we saw some of that today in all of the indices, particularly the Russell. So Jay, I'm going to hand over to you. Maybe you can talk to us about what options expiration is, why it affects markets, and take it from there.
Thanks, Alex. Okay, so to get started, what I did was I went back and I collected the quarterly option expiration dates for the last, going back to March of 2020. Okay, and then if we go ahead and we plot that, this is a view from Thinkorswim. And what we can see is if we look at the chart, these red lines signify quarterly options expirations, and you can kind of see there are some cases here where we have major inflection points in the stock market. Okay. So often what happens though, you could have a potential change in direction because there's significant changes in dealer hedging flows, but also you can have these periods of kind of weakness, so like you'll see the market kind of go up and you kind of see it tail off, and then you'll see it go up and you'll see it tail off. And I think some of the phenomenon behind that is basically traders are closing options that are expiring and potentially rolling them out to future dates and maybe strike prices that at further out of the money, and that reduces the amount of hedging that market makers have to do. Okay, so if it's a large index, if it's like a large index like SPY, typically traders sell covered calls. The majority of calls are sold, which means the dealers basically are long calls. In order to hedge those long calls, they have to basically short the underlying stock if the market goes up, and they essentially have to buy those hedges back if the market goes down. So that kind of creates this can create kind of a pinning effect going into Opex. But also you can see if basically they have less to hedge, they're going to be releasing these long stock positions that they have. Okay, so this is June of 2022, and I think it's most helpful to look at these option positions along with some technical analysis. So this is June of 2022, and you kind of see the market kind of came down, and you can see like a doji candle, which often means a potential change in direction. Right. And at the same time, you kind of see the relative strength is bottomed out, the MACD is flattened out, and the volatility is really high. These kind of these pieces of evidence, I think, kind of conspire to help give you some idea how things might go.
Yep.
And this is from last summer, June, July, and August. You can kind of see a little bit of an inflection point here in June, and you can kind of see some weakness here. You can see some potential change in direction here. Okay, so it's more of a stylized fact. In general, you can basically have a change in direction. Typically, what you often see is some weakness for a period of time. And I think that weakness is associated with people's unwinding their option positions.
Yeah.
And this is a recent time, so you kind of see this flattening or weakening here. These are this is a monthly. Here's another one, kind of flattening or weakening, kind of flattening or weakening. And this is where we're right now. I want to go back and show one more thing, but I'll get back to that. So the behavior of indices and individual stocks can be quite different. and you have to think of the context of what's going on. So this is NVIDIA. You can keep, this basically shows strike prices, and this is what they call gamma adjusted open interest. But you can kind of see there's a lot. The main thing to recognize here, there's a lot of green, and that represents a lot of call activity. And these calls are not being sold by traders; they're being bought for speculation. So in the case of NVIDIA, what happens is people are buying calls because they think NVIDIA is going to keep going up. So dealers are short those calls, but in this case, they're buying the underlying stock to hedge those call positions. So that actually helps drive the price up.
So this is a way in which the act of buying calls in volume actually is somewhat self-fulfilling, because the hedging flows as a result mean that the stock moves up. So the more calls that are bought, at least within reason, the more the stock itself moves up, as long as the call volume within a certain expiry time frame is sufficient. Then actually the options drag the stock around. We see this quite a lot.
That's right, and it's more significant if the strike prices, where there's a lot of calls, is close to the current spot price of the stock. Okay, so maybe perhaps that might explain some of the weakness of NVIDIA yesterday and today. Some of these options are expiring, traders are closing them, dealers are unwinding these hedges, and since they've been buying a lot of the stock to hedge, they're probably selling off some of those hedges, and that might contribute to the weakness.
Right.
Yeah, and you can kind of see if I drill down and look at the trade level data, you can see there's just a ton of calls right around the 900 strike price.
Yeah.
And so that means the price is pretty far north of that, meaning the dealers are fully hedged here. Okay. Now, if we look at the SPY, we might see something a little different. So again, with the SPY, most people are selling calls, covered calls. The dealers are essentially long calls, so they have to actually short the stock. So this creates more of a buffering effect. Stock goes up, they sell a little bit. Stock goes down, they buy a little bit. So it kind of creates some gravity around the price movement. As it turns out, there's significant call levels at 515 and like 520. And this chart was from this morning. You can see there's a lot of this volume profile here. I don't know what that is, a little over north of 515. You can see right late in the afternoon, there's a lot of buying. So to me, it looks like
this is yesterday, Wednesday.
I generated it this morning before the open.
Yeah.
So it's like after the close.
Yeah.
So it's really kind of interesting. It got down around this 515 level. The price was kind of supportive.
Yeah.
Okay. And this is the same view that I showed with NVIDIA with SPY. It's basically showing all the different strike prices. And this is looking at trade level information. There's a high concentration of recent trading right at that level. So how can we actually use this data to do something maybe useful for it? So this was generated this morning before the open. Is this the right? Yeah. Okay. So this was generated this morning, and this is the option level at 515. This is the level at 520. My guess is tomorrow morning when I generate these plots, this one will be bigger and this one will get smaller. Okay. But you kind of see this one looks like it's kind of providing some resistance there.
Yeah.
So what we can do is when you get in these situations, when you get this consolidation at these certain levels, there's trading opportunities with options that you can do. So on this left-hand side, so this is February monthly options expiration. And at the time, the big number was 500. Okay. So you can kind of see how the price is consolidating around this level. Okay. So what we did in our options service, we sold what we call an iron condor, which basically means you're selling a put spread below the at-the-money price, and you're selling a call spread above the market price. So essentially, we make premium on the difference between the put that we're selling, which is more expensive, and the put that we're buying to protect our downside. And again, we're making premium on the call that we sold above and beyond the call that we bought to protect our upside. So essentially what we do is we put that trade on the afternoon before options expiration. and then we buy it back the next day.
So one of the things I like about the service you run, Jay, is you're always very focused on managing the downside. I think very often options trading is associated with trying to find explosive upside in calls in particular. And of course, that can work out sometimes, but often it doesn't. And people end up with quite spectacular losses. And one of the things I think is really great and different about your work is you always have an eye on risk control. You always have an eye on managing that downside as well as offering substantial upside. I think it's a really nice method you have going for you there.
Right. Yeah, I believe in risk managed trades. Like we talked before, if we can protect the downside, the upsides over time will take care of themselves.
Yeah.
We hope the odds will be in our favor. But in any case, it's a small trade, but a 17% return in a day is in my book is good.
Yeah, okay. For a day's work, that's pretty good.
Yeah, day's work is pretty good. And of course you can scale up the number of contracts or you can be more aggressive with your strike prices. So oops, sorry, I went the wrong way. Okay, so this is a trade I put on this afternoon, and I thought for a minute I made a big mistake because the price dropped, but it actually came right back up to the 515 level.
Yeah, so right toward the close. That's right.
Yeah. So it's centered at the 515 level, and basically the 512 and the 518 are my short strikes, and then the 507 put and the 523 are my long strikes to protect my downside and my upside respectively. So
with people join your service, your approach is, you work out these risk managed ideas and you publish ahead of time. You say, look, I think this is a good approach to take. This is a good strategy. This is why. This is what I'm doing with my own money. And then you'll report back on how they work out. And one of the other things that I really like about how you run the service is you're super responsive when people have questions. There are some complexities to the strategies you use, as will be apparent to anyone watching this, but your understanding is crystal clear, and I really like the way you help walk people through what you're doing, why. When people have questions from left field, you take them. It's a great approach, and I see you building a terrific community in the service there.
Right, and we're attracting some good people too that are help really improving it.
Yeah, that's right.
So we don't just trade indices. As a matter of fact, I would say the majority of our trades are really individual equities, because we find on a recurring basis we get better premium by selling options against individual equities.
You mentioned this the other day, and your view is options markets and the indices are just that bit more efficient, so it's just harder to find an edge. But there are more opportunities in the single name stocks because they're just not as keenly followed by quite as many presumably quite large players. So you mentioned that your returns on the single name stocks have been better.
Yeah, they have. Typically the volatility on individual stocks is higher.
Right.
And then what we do is we have models that predict what we think the volatility is going to be. So one of our fundamental strategies is to find stocks that have relatively high, are priced to have high volatility,
right,
through something called implied volatility of the pricing model. And then what we try to do is predict what we think that the real volatility is going to be. So if the price is such that it's pricing for more volatility than we think it's going to be, then we think that's a good option for us to sell.
Yeah, got it.
Nothing's perfect, but it just helps us layer on the odds in our favor.
Yeah, no, that makes sense.
But I would also add, though, there were periods of time where I traded more index options and they work fine. But we're kind of in a regime now where for the major indices, the volatility is really compressed.
Yep.
And it's hard to make consistent premium on trading indices.
Yeah.
It'll change eventually, I would think. Not now.
Yeah. That's great, Jay. Thank you. So, folks, options expiry is tomorrow, Friday. We have FOMC 19th and 20th next week. And as Jay has shown you with some of the slides here, these can often be turbulent times in markets. That doesn't mean the market's going to dump tomorrow or moon. It's just that one ought to prepare for some volatility and try to find ways to take advantage of that. If you'd like to learn more about Jay's work and his service, go to our website, cestriancapitalresearch.com, click options at the top, and you can read all about Jay's work, and you can see more video content that he's produced for us there. Any questions you have, you can fire them at us in comments to the YouTube video here. We read them all and endeavor to answer them quickly. And of course, if you'd like to become a subscriber, we'd be delighted to see you there. So Jay, thanks once again for all the great work and terrific presentation today. And let's see how Opex goes tomorrow. Thank you.
Thank you, Alex.